What's up guys, welcome back to InvestingPH. It's a new year ahead of us, and what better way to start our year than to invest in strong undervalued companies that gives us a good amount of dividends. Dividend value investing for me is such a great strategy even when your stocks don't move, which is what's happening in the Philippine market for the past years. Our market is still down from its point before the pandemic, but though it's like that, with dividends, you are still earning money while waiting for the market to recover. And when reinvested back to your portfolio, it will earn you more dividends the next year. So with you buying not only high dividend yielding companies, but also strong, stable companies, then there is a high chance that a company will pay more dividends the next year when their earnings grow as well. This will further amplify the compounding effect of dividends reinvested, letting that snowball effect take action. So in this video, I'll be sharing with you the top 5 undervalued dividend stocks on my watch list. But before we begin, let me remind you guys this video shouldn't be used as financial advice and shouldn't be used as a basis for your investing decisions. I'm not a financial advisor, so please do your own research. The first company is FGen or First Gen Corporation. It is a power company that has a diverse energy portfolio from natural gas, geothermal, hydro, wind, and solar. So most of their businesses are renewable energy. A quick look at their financials. Revenue, though in some years have negative growth, overall in 10 years, they still managed to grow even amidst the pandemic. Although for their net income in their latest 12 months, they are still down negative 9.99%. With this, they are still far away from recovering their pre-pandemic earnings. Though it's like this, their 10-year compounded growth rate is still 7.01%, which is not bad considering they are far from recovery. Now, if you look at their net income margin, which shows us how much of their revenues converted to net earnings, pre-pandemic, they had been improving their margin. This may indicate the company is becoming more efficient in how they are handling their business. But like all companies, this had dropped significantly during the pandemic. Now, a lot of energy companies were affected due to lower energy consumption because business establishments were closed during that time. Moving to how they are growing their assets, equity is consistently growing every year. Though in their latest 12 months, it's still negative, but this may change since we still have yet to see the last quarter result for 2022. With that, their 10-year compounded growth rate is 8.22%. As to how well they are managing their debts, their current ratio is 1.71, meaning they have 1.71 pesos of current assets for every 1 peso of current liabilities. This indicates that FGen can pay up all its short-term debt or obligations with more to spare. Now what I usually look for is this to be at least above 1. For this company, they are doing well, and for their debt to equity, they only have a debt to equity ratio of 0.85, meaning for every 1 peso of equity, they only have 0.85 pesos of liability, which is really low. This means FGen is handling its debts well. Now in finding a good dividend company, knowing how the company handles its debts is really important, since for us dividend investors, we want to hold that company for a long time. So we want that company to last long and grow more in the future, because we all know debt can be a killer of companies. So we want to find companies that are growing their earnings and are handling their debts very well. Moving on to their dividends, FGen has a dividend yield of 4.54%, which is not bad. And of course, this doesn't stop our analysis. We also want a company that is not paying all their earnings to their shareholder. We want a company that is also putting its earnings to grow the company. With this, we can check their payout ratio. They only have a payout ratio of 21.81%, which is low, meaning this is the only amount they pay to their shareholders, so the remaining percent can be reinvested back into the company. Imagine this low payout ratio, and yet their dividend yield is 4.54%. This is important to know since how can the company finance its future projects if they pay all its earnings out? Now for price valuation, FGen only has a price to earnings of 4.9, which means we are only buying the company 4.9 times its earnings, which is pretty undervalued. And price to book is only 0.4, which means we are buying their equity at a big discount. Last one, my buy below price, or what price do I want to pay when I buy this company? My computed intrinsic value is 27.17. With a 30% margin of safety, my buy below price is 19.01. A quick explanation of why I don't use 27.17 as my buy below price and why I put a 30% margin of safety is no one can accurately predict how the company will grow in the future. So with that, I put a 30% off to allow some cushion for some errors in my projection. Though again, this doesn't guarantee I'm fully protected, but it's better to be conservative. As Warren Buffett said, you don't drive a truck that weighs 9,000 pounds across a bridge that says limit 10,000 pounds because you can't be that sure about it. That's why in engineering, they put a big margin of safety. So that's the concept of it as well in finance. Now before we go to our next company, if you're new to investing and don't have any clue on how to analyze or track your portfolio, then there's a simple tool that can help you, and that is simply Wall Street. I've been using this platform to track my stocks. It gives me update from earnings release, insider buying or trading, and of course, dividend announcements. This saves me a lot of time. Also, if you don't know how to compute your own buy price, then they have it for you. What I usually do for this is also put a margin of safety from their computation. So if you want to try it out, you can use my link down below to get a 14-day free trial of all their platform's features. And not only that, if you do avail your plan using my link, you get a 30% discount. So what are you waiting for? Try simply Wall Street. The next company on the list is Globe. I think most Filipinos know this telco giant. Globe's stock price has dropped again, so we can't let this opportunity of buying this popular company to waste. For their financials, revenues growing steadily over the years, though only a small growth during the pandemic. Still not bad. For their net income, the same story, but a larger growth in their latest 12 months. They grew their earnings by 36.18%, which is massive growth. Their 10-year compounded growth rate is 16.75%, which is a very good growth considering this is a large company. For their net income margin, they hover around 11 to 13.5%, but this past year, they've improved quite a bit, which is a good sign. And for their equity, we can see the same growth as well, consistently growing every single year with a compounded growth of 10.83%. As to how well they're handling their debts, this is where they somewhat fall short. Current ratio is only 0.68, which is well below 1. And if we also look at their debt to equity, they have a ratio of 3.12. So in our criteria, is within the proceed with caution. So is this alarming? Well, in the telco industry, PLDT has a much worse ratio, current ratio of 0.44 and debt to equity of 4.03. Converge, current ratio although better is only at 1.01 and debt to equity is 1.89. Now I don't need to mention Dito as the company has negative earnings and equity. Imagine that. Anyway, so in Globe's case, this is still in the average of its industry. And for their dividends, Globe is consistent as well in their payout and has a dividend yield of 4.86%, which is a little bit higher than FGen's. And if we check their payout ratio, it's only 46%, which is well within good range. A lot of their earnings can be circulated back to the company. Moving to its price valuation, Globe is trading 10.3 times its earnings, which is still quite undervalued, and price to book is 2.5, so they are priced a bit high since you're buying their equity for 2.5 times its price. And for my buy price, my computed intrinsic value is 3,434.92, and with a 30% margin of safety, my buy below price is 2,404.44. Third company is LTG, which is also my largest holding. They have a diverse set of businesses, from tobacco, distilled spirits, alcohol, bank, real estate, and a lot more. For their financials, revenues growing consistently, same as their net income, especially in their latest 12 months where they have surpassed their pre-pandemic earnings. With this, they have a compounded growth rate of 9.18% for the past 10 years. And looking at their net income margin, it is increasing every year, which is a good sign that management is becoming more efficient. For their equity, same story as well, growing at a compounded rate of 12.21%, which is really good. And as to how well they're handling their debts, this gets a little bit complicated since one of their holdings is a bank company, wherein banks have a high debt ratio because cash deposits in banks are included in their liabilities, so their current ratio is 0.66, so not bad. But for their debt to equity ratio, it is at a whopping 5.02. So is this a red flag? Well, good thing LTG gave us a computation if their bank holding isn't included. Their debt to equity is only 0.16, which is really low. As for their dividend yield, because the company's stock price plummeted, the yield also increased, and their dividend yield is a whopping 15.22%. But even though their yield is this high, their payout ratio is only 49.29%, so they can easily maintain their dividend payout and still have more to spare to reinvest back into the company. For price valuation, P ratio is only 3.4, which is really undervalued, and price to book as well is only at 0.5. Lastly, for my buy price, my computed intrinsic value is 17.79, and with a 30% margin of safety, my buy below price is 12.45. The fourth company is AUB or Asia United Bank. Now, as mentioned a while ago, since banks have different financials, I have a different analysis for it. Now, for their revenue for the past years had grown consistently, and the same for their net income. Now, there was a larger drop during the pandemic since a lot of bank companies put away a larger loan loss provision. This is for preparation for any unpaid loans. So this cut hard the earnings of most banks in our country. So even though a lot of banks had higher revenues, in their net income, it was still a large negative growth. But even with that, AUB was able to recover quite well, and even surpassing their pre-pandemic earnings. This gives them a good compounded growth rate of 14.88% for the past 10 years. As for their equity, the same story, although still a slight negative growth in their latest 12 months, but this can still change when the last quarter financials is posted. Their compounded growth is 12.74%. Now, instead of debt ratios for banks, what I look at is their loan-to-deposit ratio. This is used to assess a bank's liquidity by comparing the total loans they give out to the total deposits. Since if you know how banks earn, they give out loans to people to earn interest from it. So if this ratio is too high, this may mean that the bank may not have enough liquidity to cover any unforeseen fund requirements or unexpected withdrawals. And too low may also mean the bank may not be using their money to earn as much as they could, meaning the money they have is just stagnant and not used to earn more. So a good ratio for this is at least in the 80 to 90% range. So for AUB, it's at 67%, which is quite low. So does this mean they aren't using the money they have efficiently to earn more? Remember, we are still recovering from the pandemic. Most banks had been conservative during these times. Pre-pandemic, AUB had loan loss to deposit ratio of 79%, which is a good move for banks as to be safe. Next, for their dividends, AUB has a dividend yield of 4.83%, and even with a good yield, their payout ratio is only 17%, which is very conservative. For price valuation, AUB only has a PE ratio of 3.5 and a book value of 0.5. And lastly, for my buy price, my computed intrinsic value is 68.80, and with a 30% margin of safety, my buy below price is 48.21. The last company is FLI or Philinvest Land. Now, the real estate industry was hit hard during the pandemic. This caused most real estate stocks to drop. Looking at their financials, we can see pre-pandemic, their revenue had been consistently growing, but in 2020, it dropped hard, having a 31.92% negative growth. Though in their latest 12 months they've had positive growth, it's still far away from their pre-pandemic revenue. And in their net income, the same story, but a bigger negative growth. And in their latest 12 months, they fell down even more, though this may still improve since we don't have the last quarter for 2022. The big drop in earnings was attributed to larger spending for their projects. This puts their 10-year compounded growth rate in a negative. Looking at their margin, ever since the pandemic, it drastically fell. Now, since most real estate companies had a massive cut during the pandemic, which is already reflected in most of their stock price, this is the only downside to this company since we don't know when their earnings will start to recover. Moving to their equity, the good news, even though their earnings drop, they still managed to grow by 18.42% in 2021, which is a big growth for them. This puts their 10-year compounded growth at 6.80%. As to how well they manage their debts, their current ratio stands at 3.88, meaning they have 3.88 pesos of current assets for every 1 peso of current liabilities, which is really good. Though with their earnings dropping, I hope they can put more of their assets to produce more income for them. And for their debt to equity, they only have 1.22 pesos of debt for every 1 peso of equity. So Philinvest Land manages its debts well. Now, this is really important to know since we can see equities growing and debt is managed well. So even though their earnings had been cut by the pandemic, we can assume that they can weather the storm. Unlike if what you're holding has a really large debt and earnings are getting cut, then that's a time I won't be comfortable holding that stock. But for FLI's case, I can see the company's continuing its projects, growing its assets, and managing debts well. So I have that confidence in me that the company will rise again. As for their dividends, though they decreased it, which is a given because their earnings drop, since their stock price also fell, their dividend yield is still 5.28%, which is still high. Now, if you're thinking they are giving out all their earnings to please their shareholders, well, their payout ratio is only 43.6%, so a lot of their earnings are still reinvested back into the company. Now, this is what I'm aiming for investing in FLI. If their earnings recover and go back to their pre-pandemic dividends, then I will get a higher yield since I bought it at a cheap price. Though I don't know when that will happen, but it's easy to wait since I'm getting a large amount of dividends every year while waiting. For FLI's price valuation, even though their earnings drop significantly, their PE ratio is only 8.2, and price to book is at a very low 0.2, which means we are really buying their equity at a huge discount. Now, I updated my buy price for FLI since their earnings drop. My computed intrinsic value is 1.32, and with a 30% margin of safety, my buy below price is 0.92. So this ends this video for today. Now, if you don't have yet a Philippine broker, then you can try out Mercantile Securities. You can open an account using my link below. And I just want to remind you again to please do your own research and don't just rely on what I'm saying. It's fun to research different companies. You can learn a lot from it, and it really helps you out in picking the best stocks for you. With our market still trading sideways, this is a great opportunity for us dividend investors to buy a lot of great companies that pays a good amount of dividends and is trading at a fair price. And when you receive your dividends, I know it's tempting to spend it, but do reinvest it. Doing this for a long time will activate that snowball effect, and eventually, your dividends will grow to an extent that you can retire comfortably with it, which is my goal as a dividend investor, to retire comfortably from my dividends and still be able to invest some amount to let it grow even more. Although it's a slow process, but eventually it will all be worth it. It's better than setting your money aside in banks that gives little to no interest at all. So I hope you've learned something from this video. So before you leave, I would appreciate it if you click the like button. And if you still aren't subscribed, do click the subscribe button as well so you won't miss out whenever I post a new video. So thank you and see you in the next video.